Hi, we're beginning our investing and interest rate section of the personal finance unit. So make sure you have your note taker out. Some of the stuff is going to be on the test, but all of this stuff is going to come up in some of our in-class activities, stock market simulation, whatnot. Now, let's start with those goals that you have, whether it's a down payment on a house, or maybe a car. Perhaps you want to go to college, or travel might be your thing. You are going to need to find a way to pay for this, and some of this can get rather expensive. So this is where investing can help you on those midterm and long-term financial goals. The act of investing is using your money or a business ownership with the hope of earning additional income or profit. The idea, of course, is, well, simply put, letting your money earn you more money. That is the goal. Now, this is not the same as gambling. It does involve risk, however. Gambling, there's no rhyme or reason. Investing, you can figure out effective ways, but you still need to understand you can always lose more money. And the level of risk goes up with the level of profit you're looking for. If you're hoping for 12-15% return on your investment, you could potentially lose a lot of money if things don't work out right in your plans. But proper investing helps you meet those financial goals you're going to have in your life. Look at it this way. Getting rich is not a function of investing a lot of money. It's a result of investing regularly for a long period of time. And I'm going to show you how compound interest can contribute to that. Here's an example right here. If you had started at 20 years old and you put $2,000 away each year, so we're talking less than $200 a month. From the age of 20 on up to 65, you could have almost $185,000 if you just invest 3%. Just invest 3%. Now, look at something like a 401k. So if you start at 20 and you start putting money in on a 401k, you could be looking at $500,000, depending on how well you are at, how good you are at picking. You could become a millionaire. Of course, this is risk, but the reality is a lot of people do this, and a lot of people find success with smart investing. Let's talk a little bit about something we've talked about earlier, interest. Whenever you loan or borrow money, there's always a cost. That additional cost we call interest or interest rate. It's calculated as a percentage of the loan itself, and we're going to get into this on future units, but simple interest is simply interest that's based on the original investment or loan. If I owe $500, every time I calculate the interest for every year, I calculate based on that $500. So if I earn 10% interest every year on $500 investment, every year I'm looking at $50. Every single year is what I'm going to make. Compound is different. It is interest plus. It's based on the original investment or loan plus the amount earned. So in the first year, that $500 investment, I'll earn $50. The next year, it's calculating off of $550. Well, now my investment earned me another $55, and I add that to the original amount, $605 in year 3. You can see very quickly some of that can mount up in terms of price. The beauty is, at your age, time is on your side. And that's the great thing about compound interest. You don't have to start putting $5,000 away in your teens and your 20s. Now, for example, $100 at 5% is $105. But with compound interest, instead of $105, that 5% on compound interest adds the original to the interest earned. Now you're looking at $110.25. Small amounts of money at the beginning, but it can add up to huge things. Here's a better example. If I invest $1,000 on a simple interest versus compound interest, mostly annually, the monthly's up here, but that's not as usual for investments. Simple interest over that period of time will get me a value of $1,600. Okay, that's not terrible. I mean, you're looking at $20 per year. But look at the difference for compound interest. I'm making hundreds of dollars more. and I'm still only contributing about $20 a year. It pays off. Now, the important thing to think about compounding, it speeds up the process of gaining wealth and it maximizes that earning potential. But you got to leave it alone. You can't be pulling the money out. You want the compound interest to stay with the original investment because that's all going to be combined and earn you even more money. Let's talk about some of the types of investments you have. Now, a very low risk but low benefit one is a savings account. Very low interest. You can see we're looking in some cases maybe 1%, maybe 2%. On $10,000, $211 is not a lot of money. Now, it's very safe, but it's also very little. So the low risk does come with, low benefit. Money is easily accessible. You can pull it out at any point. Now compare that with a money market account. There is a higher interest rate than you would get in a savings account. It is also easily accessible and also low risk. You got to have a minimum balance on this one, and the interest is taxable. You can get taxed on this. This is seen as a specific investment, and the government's going to get its money. And unlike a savings account, this is not FDIC insured. So you're taking a little bit more of a risk than a savings account. Let's look at the next riskiest, which is called a CD, a certificate of deposit. Essentially, it's higher interest than a savings account or a money market. Okay. It is not easy to access, though. If it's a 6-month CD or a 2-year CD or a 5-year CD, you really can't cash out early. You could sell it to someone, probably for lower than what its value, but you got to leave the money in. The longer you leave it in, the higher your interest rate. 5% off 6 months, you're doing okay, but you can't touch it. You can't grab it earlier. And just like any investment, the interest is taxable. You may have heard the term bonds before. Really, all a bond is a loan, either to a corporation or to a government. Half of our schools in Washoe County have been paid for by bond measures. We borrow money from the community, pay them back with interest, we get the school. You are going to get a higher interest than CDs, but remember, the return may be lower than would it be for something we're going to talk about, which is stocks. So now you're talking medium level of risk. Government bonds, because they're, insured by a government, they're less risky than a corporate bond. Corporations sometimes collapse. Governments almost never do. And just like with any other investment, this is also taxable. So the stuff you get from this, Uncle Sam's going to get a portion. All right, let's get past this video. There we go. Now, stock market. We will spend a lot of time on this. Remember, buying part of a company, a publicly traded company, is a stock. You saw Elon Musk spend $44 billion buying Twitter. You have any number of stocks from Apple to Amazon to where you can be part owner. As the profits of that company go up, so does your stock value. Right? And that's important because there's a high potential rate of return you can make. And if you look at this graph right here, in some years, the stock market did great, but there's higher risk with using a stock market. Now, there's no limit. You can pull out at any point that you want, and yes, you will pay taxes on gains. In fact, it's called capital gains. So let's talk about mutual funds. These are investment companies that have combined different stocks from different companies in different parts of the economy. It is less risky than simply buying stock from one company. If one company falls apart, you lost your entire investment. A mutual fund is multiple investments from multiple companies. But it usually means a little less interest gained than a stock itself. And it doesn't really require a whole lot. I'll go over this in a little bit when we get to the 401k and the IRA. Let's take a look at, for example, the average investment return. So savings accounts, maybe 2%, closer to 1%. A CD, just a 1 year, 4.5%. Okay, that's not bad. Long-term bonds, closer to 6%, a little more if it's corporate. Stocks, 10%. Wow, if you're really good at investing, you can build that value quite a bit. Mutual funds, a little safer than straight stocks, because remember, it's a combination of different stocks. Now, that's important to keep in mind because every year prices go up about 2.5% to 3%. Savings account is not going to allow you, when you're older, to keep up with inflation, which means you're going to have to come up with another way of finding money for retirement. We're going to spend a little bit of time on the rule of 72, but the idea is you take the number 72 divided by the percentage on compound interest. It'll tell you how long it'll take to double. So a savings account, if you're earning 2%, it's going to take you 36 years to double that investment. A CD, that'll only take you 18 years. That's half the time of a savings account. A government bond, 13 years. Okay. How about just a stock? If you're talking a pretty successful stock at 11%, it's only taking you 6.5 years in order to double your investment. Mutual fund might be a little more, but again, it's a little safer. Now, the thing that you're going to have available, it's a pre-tax account. There's a couple of things you can do with this. First of all, the beauty of most of these, not the Roth IRA, but the beauty of most of these is you don't pay tax until you retire and you take your money out. And because you were contributing to your retirement before your taxes are collected, essentially you're putting money away and it lowers your tax bracket. As far as the government's concerned, you're making less. You can borrow from those investments, a 401k for example, before you retire, and as long as you're paying it back, and there's fairly easy terms to pay it back, you get to keep the interest. So there's a huge benefit to these type of personal savings plans. You may have heard of an IRA or an IRA. That tends to be post-tax. That means after taxes are collected, but it is a great way to secure a lot of money in a short period of time. 401k, most jobs have this to where the employer will contribute to your retirement. You contribute a certain percentage. They contribute a certain percentage. As time goes on, your investment grows quickly. And then even to pay for your children's college, a 529 college savings plan. I put away $50 a month for each of my daughters. They're looking at about $20,000 each when they go to college. It's a nice way to secure their future. So when we talk about a 401k and how it helps your tax benefit, I am putting in $41. As far as the federal government is concerned, even though I made $824, they think I only made $783. They're going to tax me on that $783. That $41 is not taxed now. It's not even going to be touched till I retire. But look at the benefit. You look at from age 30 to age 64, simply contributing that amount of money every week could build me a small nest egg of over $500,000. That's great for when you're retired. Between Social Security and anything else you have, that's going to help you prepare for long-term success. And just as beautifully, you can increase the amount of contributions as you go along in your job. So if you look at increasing the contributions by just 1%, starting at age 35, you're looking at an extra $85,000. That's $12 a week, long-term benefits. The safest advice that any investment person would tell you is diversify. You don't want to just put your money in one thing. You want to have a variety of investments like stocks and bonds and mutual funds and CDs. All of these have varying levels of risk, but it limits the overall risk if you can diversify and put your money into gold and other things in addition to stocks. You should always feel free to take more risk when you're young, but once you get to, well, frankly, my age, you begin to pull back on that risk and you go more conservative to make sure that you have preserved your money for the future. Because let's face it, the biggest goal of all is retirement. If you have any questions, I want you to come see me. Make sure you filled out this notes page, and we will see you next time in class.